It's not that complicated. It's not very complex. We're going to give you guys all the tools that you need to be successful here, and just all you really need to do is follow the script that we've kind of laid out for you. When it comes to getting an approval, there's very little in the way of underwriting. For those of you that have done commercial loans and commercial lending in the past, you'll appreciate this because, you know, in many cases, while a lot of those go through and you can make great commissions in regular commercial financing, many times it can take a long time to get underwriting, and there are certain ways that deals can get killed along the way. There's valuation issues and different things like that. So this really doesn't have any of those normal pitfalls that you find in commercial financing. One of the things that I really like, and I think a lot of people really appreciate as well, is these close very, very quickly, which means to us we all get paid much faster. So you get an approval. By the way, I don't think we have it in the notes here, but the approvals typically take 24 to 48 hours to get an actual approval.
Wow.
It's not just a letter of interest. It's a real approval. They can fund from that point. It takes anywhere from 7 to 10 business days, and those approvals are funded, and we're paid within 7 business days of that funding. So really, from start to finish, it can be a 2 to 3 week process. And, you know, like it says in here, I think many people already know somebody who could use this program. And, you know, it's just a matter of picking up the phone and letting them know that we have this. Many of the businesses will be currently using a form of this program, as this is not, this particular program is not necessarily new. There are some competitors out there which we'll talk about. But we're different, and we have a number of different things and aspects about this program that really separate us from all of our competitors. So we have a humongous advantage over our competition with a product that is almost universally needed and required by the small business community. So it's a great program all the way around.
This is what I really like. I like very little underwriting. So a lot of times when a loan is going to be done, you know, you talk to a loan officer, and then the loan officer brings up this loan committee, and you never get to talk to the loan committee. That's like always something that they meet privately and all that. And then that's when they say, the committee came back with this and that and the other thing. I mean, I've gotten plenty of loans, but, you know, it's always a drag when you hear back from the loan committee. Are you saying that sort of process isn't something that we have to worry about with these kind of small business lines of credit?
That's correct. There is a small committee here, but they meet in that 24 to 48 hour period and review the file. So what we're getting is an actual approval. And once that happens, then it's just a matter of getting the documentation for the funding. So it's a very quick process.
Okay, that's very cool.
Yeah,
that's very cool. And it's an easy sell, because there's really very little selling involved. It's mainly just answering questions about the product and just, you know, mentioning it and just asking, you know, would you mind if I just got you a quote on this? And if we get you approval, you can always keep it as a backup. You don't actually have to draw any money unless you ever need it. Is that about the size of it?
That's about the size of it. Yep.
So, like, every business should be doing this, and if they're already involved in a line of credit, they should consider another one. And, you know, just have it sort of as a backup. And everyone will end up needing it. I mean, I've been in this situation. I was telling this story. I think I wrote it in the blog today, or recently. I was telling a story about a couple times when I needed cash right away. And one time was when I had to meet payroll, and I didn't have the cash in the bank to meet payroll. This was years ago. And I was really struggling in this business, not the business I'm in now, but another business. So I didn't want to have to face the wrath of 40 people, you know, who were expecting to get paid and living hand to mouth, and then I didn't pay them that day, and it was Friday, and, you know, it was horrible, and then the morale would plunge, and who wants to be in that? It would be like a nightmare. So I ran home and tried to find this check that had been sent to me by a finance company. You know, and this is the kind of check where if you cash it, then you automatically make yourself a loan by agreeing to all the terms and conditions, you know. Now, you know, we all get these things from our credit card companies. This was actually from a finance company, which is sort of a lower tier of, more expensive tier of debt, but sort of easier to deal with than a credit card company. And I did find this check, and I deposited it, and I was able to meet payroll because of it. And the company went on to be quite successful, and really, had it not been for this availability of quick cash, I would have been sunk. So,
wow. Yeah, first-hand experience. There you go.
Yeah. And another time, I've done factoring, and can you explain? Is there a difference between this and factoring? With factoring, what I would do is I would get an invoice. I'd invoice a customer, so they'd owe me money. Let's say they owed me $1,000, and then the factoring company would give me $920, and they would then collect from the customer.
Right. That's correct.
That was
yeah.
factoring.
Essentially, factoring is just it's a numerical factor or amount based on the amount of receivables, and in this case, it's credit card receivables that they look at. They look at what you've been taking in as a business annually and monthly over the last. Really, this is only looking at 6 months. Some of our other programs, which we'll get into in this call, are look at a little bit longer history, but mainly they just take an average of your receivables and will loan you an amount based on that. It's actually really not a loan. It's a purchase of future receipts is really what it is.
Yeah. So when they bought the invoices from me, they would own those invoices. Like I had already signed like a single blanket paper that gave them, assign those to them. So then they own them.
Right.
And then under certain conditions, if my buyer didn't pay the invoice, the business might have to pay them back. But it could be non-recourse, it could be recourse. But basically, we were selling off those receivables. So we're talking about every business. A lot of businesses don't have receivables. Like receivables when a customer owes you money because you had to bill them because you can't collect up front. In the old days, a lot more people use receivables than use them today. When we used to go to the doctor, they'd give us a bill, and you'd pay the bill, and some doctors still do that. But nowadays, more and more places are cash businesses. Like they want you to put it on a credit card or cash. They don't want to bill you. But there's a lot of B2B businesses where they still bill you.
Right.
And if you're in a business where you sell to customers and you're invoicing them, then factoring is an option. But what we're going to talk about is much better than factoring because the cost of money is much less. And it'll work for any business that has either bank account or cash going to bank account or cash on credit cards. Just about any business. So it doesn't have to actually bill customers. So there's a really wide variety of businesses where this will work. Just about any business, really, that has a credit card merchant account, and then in another program, businesses that actually just put, checks into their bank, that can work for them. And it's a lot better than factoring, actually.
Yeah, that's correct. I think the key to remember is it's just a matter of what has this individual business been bringing in, and that's evaluated, and then we're going to come back to them with terms. And the real difference, and we'll get into this a little bit in a few minutes, but the real difference between us and the rest of the competition is that our company is actually privately funded. And because we're privately funded, we're able to offer this program at much more flexible terms than any of our competition. So we're going to give some examples here soon of recently funded transactions where we took a client that was already using some form of this program with one of our competitors, and we cut the cost or the return of the money, I guess is a better way to say it. We cut that in half or more, and so therefore we've increased their cash flow, which is really the focus of the business typically. That's what we're looking to help, and by the flexibility of our program, we're able to move them into a much better cash flow position, and that's really the crux of what this program does. It allows them to get the capital they need, but also the payback is going to be at a thing that makes sense, and we're not going to stress the business. Where many of our competitors, they don't really seem to care. They just want the return on the money. We're not looking at it that way. We're trying to work with the business. We want the business to be successful, and obviously, one of the best parts of this is we want them to return, and all commissions paid out are paid as though they're a brand new customer. So what happens and what we found is that a lot of clients will come back to the well over and over and over once we've gotten an advance. And actually, we can advance on top of a current advance as well, which our competitors won't do. So,
well, okay, so what?
Quite a bit there, but
the big picture here then is that this is somebody takes credit cards or cash. It goes to the cash register, so to speak. You know, day 1, day 2, day 3. Normally, that money would then appear in their bank account, and they keep collecting money from customers. And you know, maybe if they're needing some cash, they just can't do it because they just keep having cash go in and cash go out. Whereas with this, what they can do is we can advance the day 1, day 2, day 3, maybe day 30, day 60, whatever. We can advance all the money they're going to be getting and write one check to them that goes to the business.
That's exactly right.
Okay,
yes.
and then they pay it back a little bit at a time as they get the money coming in. So they'll have enough money to pay their bills and meet their expenses, and then some of that money that they get in from the credit cards and whatnot will go to pay back the loan or the advance, basically.
Correct.